Let's take a look at the 2008 bear market because what's happening right now in this bear market in 2016 is pretty similar to what happened from March to May, um, potentially in the 2008 bear market. So back in 2008, when the S&P 500 finally broke below about 1400 back in early 2008, it made a short-term low in the second week in March, and then took about 2 months to rally back to the 30 and 50 week moving averages, back above 1400 before really the meat of the 2008 bear market took place. So right here was the ideal short entry point to really make a killing over the next 6 months or so, as all you had was one more counter trend rally, and then the big collapse. But this is I've talked about this in videos in the past, but this is why bear markets are so tricky: is that you get rapid plunges and then the market grinds sideways to higher for multiple months before the next shorting opportunity occurs. So you typically want to wait for the market to be above the 30 week and even above the 50 week moving average before entering the short side once again. And we can see here that the market actually spent 1, 2, 3, almost 6, 7 weeks above the 30 week moving average before it finally, um, the downtrend resumed. And we can see that one of the reasons why it spent a lot of time here is because this level of 1400 was being retested again, and held up as resistance, which was formerly support all during this time period. So this critical area was the line in the sand between the bulls and the bears took control again, and the market started plunging. Now, taking a look at the percentage of stocks above the 50-day moving average back then, we can see that it bottomed in March around 15% and rallied all the way back above about 80% is where it topped out, and then the bear market resumed. And I've talked about the above 75% or so is where the market seems to top out typically in bear markets. So we can see that about 70% is where that little rally topped out again before the big plunge in 2008. Now, looking at the current situation, um, we can see that we've plunged, back in August, plunged again in January, and really the line in the sand is this 2000 to 2050 area in the S&P 500. Um, so after we bottomed in February here, we're now in another counter trend rally. So we've been in this counter trend rally for about a month now. So if we compare this to 2008, we could spend another month maybe fighting the 2000 to 2050 resistance, which I think this is going to be the line in the sand between the bulls and the bears. The market has about a percent or so to go before it gets to about 2000, and then it's got another 4% or so to get above 2050. So this is really where I could see a lot of congestion happening over the next month into April or so, and it's really going to determine whether we top out again, or if we break back above it, it's either going to be a low risk shorting opportunity or establishing a base and then a new resumption of the bull market. But we'll cross that bridge when we come to it. Now we look at the S&P 500 percentage of stocks above the 50-day moving average, and we've already rallied above 70% as of March 1st. So we only have 5% to go to get above 75%, and then to get it, to 80%, we're pretty close there. So, depending on what happens, like I said, I think this 2000 to 2050 area is going to be a lot of congestion, and we're going to see this percentage kind of start probably moving sideways as we start fighting resistance, and we'll just see how the market handles resistance and whether more leadership can evolve out of the market or it starts to establish itself as a topping area. One sector to look at is the financials, and in 2008, you can see that the financials went up and kissed the 30-week moving average before resuming their bear market. So they were lagging the overall market, and this was a bearish sign for obviously the market back then, and which is what the financial crisis is what hammered all these banking stocks. So right now, like the energy debacle is ravaging these stocks, and the XLF is lagging the market once again. So we need to see what happens as the XLF retests the 30-week moving average once again, and if it starts to establish itself as resistance, I think it's going to be pretty bearish for the overall market. And then similarly, the energy stocks are also lagging the market right now, so they're going to be an important sector to watch. Is if they continue to observe the 30-week moving average as resistance, it'll be a bearish sign that the collapse in energy stocks is still ongoing. If you use my screening tool at screener.nextbigtrade.com, you can observe a few things to help kind of see how this bear market evolves. One thing is that if you go to the U.S. sectors page, you can see which sectors are leading and lagging the market. And we can see on here that the XLE and XLF are the two big laggards in the market right now, along with healthcare XLV. And you can see that there's a lot of overhead resistance too in these ETFs. So once these ETFs get closer to their 30-week moving average, we want to see how they act as far as determining whether the market can actually break out of this bear market or if it's going to remain within it. Another thing to pay attention to is the watch list, because this list will grow in size as more stocks start breaking out into bull market mode. So if the number of stocks in this list remains low, it means that the market isn't healthy and there's going to be no new leadership in the market to push it higher. Another thing to look at is the market indexes, and basically, like, the NASDAQ is not going to be the laggard in the overall markets if the market is healthy. Right now, the whole situation is upside down, where the Dow Jones is the strongest index and the NASDAQ's the weakest. This is going to completely reverse itself if the market resumes into a bull market. So you'll see a larger percentage of stocks in stage 2 in the NASDAQ, and that should exceed what's going on in the S&P 500 and the Dow Jones. So in conclusion, looking at the S&P 500 currently, I expect this upcoming zone here to be the battleground. And then really, if you think about setting up another awesome shorting opportunity, if you can establish short positions around 2050 or so, you only have a couple percent to place your stop above, and then the reward is tremendous. If we get another bear market down leg that takes us down to like 1600 or 1700 or something, you're talking about 300 S&P points for a risk of maybe like 50 S&P points. So that's a 6-to-1, maybe even more of a trading opportunity there. So and by the time the S&P 500 gets back to this level, a lot of bears will have thrown in the towel, and the media will be talking about the resumption of the bull market, and will be foaming at the mouth about buying stocks. So it'll be setting up the perfect opportunity to take the short positions that people will finally feel uncomfortable with.